In financial history, some names leap off the page. Sharos made headlines with a single bold strike. Jesse Livermore rode booms and busts. But Michael Burry carved out his legend in a very different way through patience, deep research, and the courage to stand alone when the world thought he was crazy. Burry, a doctor turned hedge fund manager, didn't start on Wall Street. He studied medicine, but his true obsession was the market. Nights in front of screens, poring over company filings, hunting for overlooked value, that's how he built his reputation. He launched Cyan Capital in 2000, just as the dot-com bubble burst. Where others panicked, he found underpriced companies and delivered outsized returns. His style, contrarian, data-driven, uncompromising. By the mid-2000s, Burry saw something far larger than a stock trade. He dove into the U.S. housing market, reading bond documents line by line. What he discovered looked toxic: subprime mortgages, adjustable-rate loans, risky borrowers, all bundled into securities that Wall Street rated as safe. He concluded the system would crack once interest rates reset. Most investors shrugged. Home prices had never fallen nationwide, they said. But Burry saw the math. Default rates would rise. When they did, these mortgage-backed securities would implode. Here's where his genius showed. Instead of shorting stocks directly, he looked for a cleaner way. He convinced banks to sell him credit default swaps, CDS, tied to subprime mortgage bonds. In essence, he was paying small premiums each year to insure against a collapse. If the bonds held up, he'd lose a little. If they cracked, the payoff would be massive. For a while, he looked wrong, and his investors complained. Premiums drained cash from the fund, and year after year passed with no collapse in sight. Many demanded their money back. He refused, locking in positions and holding firm. Discipline mattered more than approval. By 2007-2008, the cracks widened into a chasm. Defaults surged. Ratings agencies scrambled to downgrade securities once stamped Burry's imparsible. That turned into billions. His investors, once furious, suddenly became rich. He was vindicated but scarred by the experience. Managing people who doubted him proved harder than fighting Wall Street. Soon after, he wound down Cyan Capital and stepped back. The lessons for traders are clear. First, conviction matters, but only if built on research, not ego. Burry didn't guess. He read thousands of pages of bond documents. Second, time is a weapon. His CDS premiums looked like losses for years, but he knew the math favored him if he stayed patient. Third, going against the herd is lonely. Consensus offers comfort, but profit lives where others refuse to look. Burry didn't stop investing. In later years, he re-emerged, still taking contrarian stances. Water scarcity, farmland, undervalued companies, even Tesla shorts. Headlines love to call him the man who predicted every downturn, but the truth is simpler. He follows data wherever it leads, even if it makes him unpopular. For options traders today, his story offers parallels. Buying leaps or protective puts can feel like paying for insurance while everyone else dismisses the risk. Selling into frothy optimism can make you look foolish until it doesn't. The key isn't being early or loud. It's being right, disciplined, and prepared to withstand pressure. Think about your own trades. Do you quit when others doubt you? Do you size positions so you can survive until the thesis plays out? These are Burry's real lessons, and they go far beyond 2008. Now, if you've enjoyed this dive into Michael Burry and want more stories of the market's most daring minds, hit that like button the way Burry hit the housing bubble. And subscribe, because in this series, we'll keep unpacking the legends who shaped financial history. And remember, this is not investment advice. Invest at your own risk.